roof replacement costs about $15,000. Now, retirement savings do not hand you the whole balance. They hand you an income. A $500,000 portfolio safely produces about $19,500 a year. I will explain where that figure comes from in a minute, so hold those two numbers together. A $15,000 roof against $19,500 of annual income. The roof costs 3/4 of everything your money produced that year. You will think about it for months. Now run the same roof for somebody with $2 million saved. Their portfolio produces about $78,000 a year, so the roof takes about a fifth of it, an irritating week. At $5 million, the portfolio produces around $195,000. The roof is under a tenth. You approve the estimate and go back to what you were doing. Same roof, same contractor, same house. What changed is which category of problem it belongs to. And that is what wealth actually buys in retirement. Not a different life. A different list of things that count as emergencies. I'm Tom. This channel is about real personal finance. The kind that works for normal people instead of the kind that sells you something. No motivational fluff, no fantasy returns, no get rich quick. Just what the math actually does over time. If that is what you want, hit subscribe. So where does that income figure come from? Morningstar publishes an annual study on how much a retiree can safely withdraw. Their 2026 figure, released this past December, is 3.9% of the portfolio in the first year, adjusted for inflation after that. That is lower than the 4% rule you have heard, and it is up from 3.7% last year. It also comes with a condition most people skip. That 3.9 assumes a fairly conservative portfolio, somewhere between 20 and 50% in stocks. And it assumes you take the same inflation-adjusted amount every year regardless of what markets do. Morningstar's own research says something else. A retiree willing to spend less after a bad year and more after a good one can start closer to 6%. So, the number is not a law. It is what a rigid plan can support. Flexibility buys you more, and I will come back to that. For this video, I am using 3.9 because it gives us one consistent ruler across every level. I am also counting investable assets only, not your house, not your car, not a business you might sell one day. Your house lowers your expenses, which matters enormously, but it does not pay a plumber. Now the levels. I will describe each one by what an ordinary week actually looks like for you, rather than by what the balance sounds like. $500,000. At 3.9%, this produces $19,500 a year, $1,625 a month before tax. Add an average Social Security benefit and the household is at about $44,500 a year. For a couple with two average benefits, closer to $69,500. That second number is a real retirement. The first one is a real retirement only if the fixed costs are already handled. Here's what a week looks like at this level. You are not counting pennies at the grocery store. You have time, which is the thing you spend 40 years buying, and you actually own it now. Coffee with friends on a Tuesday morning, long walks, the garden, the library on the way home. What you do not have is much room between the planned and the unplanned. That roof from the opening takes 3/4 of your yearly portfolio income. A $9,000 furnace takes almost half of it. A dental crown you were not expecting turns into a genuine conversation at the kitchen table. None of those bankrupt you. All of them require a decision, and the decision has a weight to it that people at higher levels have forgotten about. The specific danger at this level is not overspending, it is the opposite. You start treating the balance as the achievement rather than the tool. $500,000 feels safe, and $497,000 feels like damage. Even when that $3,000 bought something you wanted and planned for. So you cancel the trip you could afford, because watching the number fall hurts more than the trip would have pleased you. That is a real cost, and it does not show up anywhere on a statement. There is a mechanical risk here too, and it is worth naming precisely. Say the market falls 20%. Your $500,000 becomes $400,000, but your spending did not fall, so that same $19,500 is now nearly 5% of what is left. You are now selling more shares to fund the same life. In the year the shares are cheapest. The market can recover fully while your portfolio does not, because you sold the shares that would have participated. The move that helps is separating your spending into two layers before anything goes wrong. Housing, food, insurance, medicine, utilities are the floor. Travel, gifts, restaurants, upgrades are the second layer. When markets fall, you cut the second layer and leave the first alone. A plan that cannot tell the difference between a heating bill and a cruise is not a plan. 750,000 to 1 million. At 750,000, the portfolio produces 29,250 a year. At a million, 39,000. With 2 average Social Security checks, that is a household somewhere between 79,000 and 89,000 a year before tax. For context, the Bureau of Labor Statistics puts average annual spending across all American households at $78,535. So this is the level where a couple's total income crosses what the average American household actually spends. The week looks different in one specific way. The furnace stops being a crisis. At a million, the portfolio produces $39,000 a year. That same $9,000 repair now takes under a quarter of it rather than almost half. You still notice it. It just does not reorganize the year around itself. Appliances get replaced before they fail rather than after one floods the basement on a Sunday. Helping an adult child with something small no longer means recalculating your life expectancy. The cash reserve sits there and stays intact for months at a time. You still compare prices because that habit is 30 years old and it is not doing any harm. The psychological problem at this level is that many people here still live as though they have 500,000. The portfolio crossed into genuine viability and the nervous system never got the message. Decades of saving trained you to read spending as failure, and retirement does not undo that training on the day you stop working. And there is a particular trap at the $1 million mark because humans respond to round numbers. The 7th digit arrives and you expect something to happen. Then the market drops 6%. $60,000 leaves the screen and you feel demoted. Technically nothing changed about your capacity. Emotionally it feels like the title was revoked. The common response is to set a new number. $1 million was the goal until you had it. Now 1.2 feels responsible. You reach that and 1.5 looks cleaner. Your expenses did not change. Your plans did not change. The target moved because arriving at the old one removed the thing that had been motivating you. The brain replaces it rather than sitting with the arrival. 1.5 million to 2.5 million. At 1.5 million, the portfolio produces 58,500 a year. At 2 million, it is 78,000. And at 2.5, 97,500. Now put that middle number next to the spending figure from earlier. The average American household spends about $78,500 a year. A $2 million portfolio produces $78,000 on its own before Social Security is added at all. That is the threshold that matters more than the $1 million one, and almost nobody celebrates it. Add 2 average Social Security checks to a $2 million portfolio, and the household is near $128,000 a year. The week here is comfortably unremarkable, and I mean that as the highest compliment available. The roof that took 3/4 of the income at $500,000 now takes about a fifth. You book the flight at the time you want, rather than the connection at 6 in the morning. You eat out without auditing the right-hand column. You replace the car when it needs replacing. You can help family meaningfully, support something you care about, and pay somebody to do the jobs you have come to hate. What you probably do not do is live like the people in the advertisements. 2 million does not make a house in an expensive coastal city painless. It does not buy a boat you use twice a year without noticing. The difference is that ordinary life stopped requiring financial heroics. A 20% decline takes 2 million to 1.6 million. That is a frightening statement to open. It also leaves an enormous amount of productive capital. Freeze your inflation increases for a year, or postpone one large purchase, and the plan usually heals. At 500,000, the flexibility protects your survival. Here it protects your comfort. Same tool, completely different stakes. The mental error at this level is confusing a low probability of failure with a zero probability of failure. No balance guarantees good health, calm markets, mild inflation, or a family that behaves. The absence of certainty does not mean the plan is inadequate. It means you are a person living in a world that does not issue warranties. The feeling you should have here is confidence, and confidence is not the belief that nothing bad will happen. It is knowing that several bad things can happen without ending the life you built. This is also where working longer starts costing you in a different currency. Say you have 2 million and your spending is covered and you stay another year because 2.3 feels safer. You are no longer trading time for financial survival. You are buying a small reduction in uncertainty with one of your remaining healthy years. That can be a good trade. If you like the work, if you are finishing something, if the structure matters to you, stay. It becomes a bad trade when you dread Monday and think about leaving every day, especially if you cannot say what the extra 300,000 changes about your Tuesday. 3 million to 5 million. At 3 million, the portfolio produces 117,000 a year. At 5 million, 195,000. Now compare an ordinary Wednesday at 3 million with an ordinary Wednesday at 2 million. You wake up in the same house. You drink the coffee you already prefer. You talk to the same spouse, walk the same dog, call the same friend, and have the same complaint about your knee. More money changes the edges of the day much more than the middle of it. What it does change is the size and frequency of the large decisions. You can fund a grandchild's education without a conversation about whether it is possible. You can help an adult child with a down payment. You can carry a second property or make a gift large enough to matter to an organization. Those are real and they can be deeply meaningful. They are also occasional. They are not an upgrade to every waking hour. Your problems also change category. Below 1 million, you worry about running out. Around 2 million, you worry about having retired too early. Above 3 million, many people start worrying about using the money incorrectly. Spending on yourself feels indulgent. Giving too much feels irresponsible. Leaving too much feels like a waste. You solve the income problem and inherited a philosophy problem, and no calculator has a field for it. The planning work changes too. It stops being about adequacy and becomes about efficiency. A large pre-tax balance creates large required withdrawals later. Required minimum distributions generally begin at 73 under current rules. At 3 million in a traditional account, those forced withdrawals are substantial taxable income arriving whether you want it or not. I made a full video on that specific problem and the window before it opens, and it is on the channel. 5 million and above. At 5 million, the portfolio produces 195,000 a year before any social security. A 20% market decline removes $1 million on paper and leaves 4. That is genuinely unpleasant to look at. For any reasonable spending plan, it is not a lifestyle event. You can travel the way you want, support family substantially, fund projects, pay for care, and modify a house for aging without a spreadsheet. You can move without selling first, and buy a car with a bank transfer rather than a loan application. Money has stopped being a daily variable. It is now a tool you reach for occasionally. What it does not buy is the thing people quietly expected it to buy. It does not create close friendships. It does not repair a relationship with an adult child. It does not make a reluctant spouse enjoy travel. It does not give you a reason to get out of bed on a Tuesday in February. And it does not negotiate with your lower back. Once financial friction gets small, everything else in your life becomes easier to see. Some people find that clarifying. Others find it uncomfortable and go looking for another financial project because that is the problem they know how to solve. Some people at 5 million continue living exactly as they did at 1 million. That can be genuine preference, and frugality can be a pleasure rather than a sacrifice. The warning sign is when the behavior comes from fear rather than choice. Say you want the trip, can clearly afford it, and have the health for it, and you still refuse because the balance might dip. At that point, the portfolio has stopped protecting you. You have started protecting it. The habits that build the money can turn hostile to the purpose of the money. Delayed gratification works beautifully for 30 years. Apply permanently, it becomes delayed living. So where does the plateau actually sit? Somewhere between 1.5 and 2.5 million for most households. The ordinary day stops changing. Above that, wealth still buys real things. Protection against a bad decade. The ability to be generous. Better options when something goes wrong. Those matter, and I am not dismissing them. What it stops buying is a different Tuesday. And the reason your brain does not notice you cross that line is that it keeps moving the line. Whatever you have becomes the new baseline within about a year, and the next number becomes the one that will finally feel like enough. There is a useful way to find your own version, and it has 3 layers rather than one number. Your floor is what it costs to keep the house warm, the food coming, the insurance paid, and the medicine filled. Your cushion covers the predictable, irregular things, meaning cars, roofs, family help, and bad market years. Your third layer pays for whatever makes the freedom worth having. 500,000 can cover the floor once Social Security arrives. A million adds a genuine cushion. Somewhere around 1.5 to 2.5 million, most households can fund all three. Beyond that, more money expands the size and frequency of the third layer. It does not invent a fourth one. That is the sentence I would want somebody to have said to me at 45. Not that money stops mattering, because it does not, but there is a point where it stops changing what your Wednesday feels like. The years you spend past that point get paid for out of a different account. Now the honest limits, because that range is not a universal answer. The first is that geography breaks it completely. A renter in an expensive metro and a mortgage-free household in a small town do not share a number. Neither of them shares one with a family supporting a disabled relative. The second is that everything here uses 3.9%, which describes a rigid plan. Morningstar's own research says a retiree willing to adjust spending after bad years can start near 6%. That is not a small difference. On $1 million, it is the gap between $39,000 and $60,000. Flexibility is worth more than another $500,000 in the account, and it is available to everyone regardless of balance. The third is that I have used the average Social Security benefit throughout. Payments in 2026 range from under $100 a month to over $5,000. Pull your own figure before you use any of this. The fourth is that a large traditional balance is not what it appears. $1 million in a pre-tax account is not $1 million of spending money. How much it loses depends on decisions you make in your 60s. So here's the question worth carrying out of this. Your number is not the largest balance you could reach if you worked long enough. It is the smallest balance that reliably funds a life you are ready to start living. If the next level up does not change your ordinary day, be careful how many of your good days you trade to get there. If this was worth your time, hit subscribe. I will see you in the next one.